So most traders believe this. If I can just win more trades, I'll finally be profitable. But here's the uncomfortable truth. You can win less than 50% of your trades and still make money consistently. And you can win 70 to 80% of your trades and still slowly bleed your account to zero. The difference is not your win rate. The difference is something much more important called expectancy. In this video, I'll show you what expectancy is, how to calculate it from your own trades, and how to use it to build a realistic, profitable trading system. Instead of just chasing being right, let's keep it simple. Expectancy is the average amount of money you expect to win or lose per trade over a large number of trades. If you follow your system, think of it like this question. If I took this exact same setup 100 times, on average, how much would I make or lose per trade? Here is the classic formula. Expectancy equals win rate times average win minus loss rate times average loss, where win rate is the percentage of winning trades. If it's greater than 0, your system has a positive expectancy. If it's less than 0, your system is mathematically designed to lose over time. No matter how right you feel, to really understand expectancy, don't think like a gambler, think like a business owner. Every trade is like selling a product. Your win rate is how often you make a good sale. Your average win is how much you profit on that good sale. Your average loss is what you lose when something goes wrong. Returns, defects, refunds. Expectancy is simply your profit margin per sale. A trader who doesn't know their expectancy is like a business owner who has no idea if they actually make money every time they sell something. That might work for a few lucky months, but over the long term, the math always wins. Let's look at some numbers. Imagine a trading system with win rate 40%, average win $300, average loss $100. Loss rate is 60%. Plug that into the formula. Expectancy equals 0.4 asterisk 300 minus 0.6 asterisk 100 equals 120 minus 60 equals $60 per trade. So even though you're losing more trades than you win, every time you place a trade, the math says you expect to make $60 on average. This is exactly how many trend following or swing systems work. Lots of small losses, but when they win big. Now let's compare that to a system with a much higher win rate. System B, win rate 70%, average win $50, average loss $100. Expectancy, 0.7 asterisk 50 minus 0.3 asterisk 100 equals 35 minus 30 equals $5 per trade. This system is profitable, but only just. One mistake, one oversized loss can wipe out many small wins. Now watch what happens if we tweak the numbers again. System C, win rate 80%, average win $20, average loss $150. Expectancy equals 0.8 asterisk 20 minus 0.2 asterisk 150 equals 16 minus 30. Equals negative $14 per trade. So System C wins 8 out of 10 trades, but on average it loses money every time you click the button. This is what happens when you cut winners too early and let losers run too far. It feels good to be right most of the time until the math catches up. So how do you find the expectancy of your trading system? Step 1, pick one system, not your whole account. Not 5 different strategies mixed together. Just one clear setup with rules for entry. Stop loss and exit. Step 2, record your trades. For each trade, log whether it was a win or a loss. How much you made or lost, ideally in R multiples. Step 3, after at least 30 to 50 trades, calculate your win rate, loss rate, average win and average loss. Step 4, plug into the formula and get your expectancy. It might be positive, it might be negative. Either way, now you're no longer guessing. You're trading based on data, not feelings. Once you know your expectancy, you can start improving it. Remember the formula. Expectancy equals win rate times average win minus loss rate times average loss. There are 4 main levers you can pull. 1. Increase your reward-risk ratio. Aim for bigger winners relative to your stop. Let your best trades run instead of grabbing profit at the first pullback. 2. Reduce your average loss. Place smarter stop losses at levels that truly invalidate your idea. Avoid widening stops out of fear. 3. Filter your setups and improve win rate. Trade fewer, higher-quality setups. Skip low-probability, FOMO-driven entries. 4. Stick to one system long enough. Constantly changing systems resets your data and keeps you from ever understanding your real expectancy. You don't need a perfect system. You just need a system where the math is on your side and the discipline to execute it over hundreds of trades. Here's the final piece: psychology. Most traders obsess over each individual trade. 1 loss, they doubt themselves. 3 losses, they change the system. A small win, they feel relieved and close early. But when you truly understand expectancy, your perspective shifts. You stop judging yourself by the single trades, and you start judging yourself by how well you executed your edge across a whole series of trades. You know that losing streaks are normal. Drawdowns are part of the game, and your job is not to win today. Your job is to trade your edge over the next 100, 500, 1,000 trades. You don't make money because you're right on this trade. You make money because over time your system has a positive expectancy, and you're disciplined enough to let the math play out. If you found this helpful, here's your action step. Take your last 30 to 50 trades. Calculate your win rate, your average win, your average loss, and compute your expectancy. Once you see that number, you'll never look at your trading the same way again. Thanks for watching. If you want more videos on trading math, risk, and psychology, don't forget to like, subscribe, and share this with a trader who's still obsessed with their win rate.